and I'm happy to bring in our special guest here, Pimco fund manager and partner Paul McCulley. Paul, good to have you with us, and that is the key question for you. What does this mean for the Fed?
I think the Fed can breathe a little bit easier after these data. They were better than expected. They were not good, but they were better than expected. So the Fed has the latitude to gather more data as opposed to having compelling pressure to move to QE2 at the next meeting.
So this pushes back QE2, quantitative easing, the second time around. Okay, pushes it back perhaps from September. So when?
Well, you'd have the next meeting, obviously. The Fed is going, meeting to meeting with respect to the data flow. I don't think it rules out QE2 at the upcoming meeting in a few weeks, but it lowers the odds for that. There's a great deal of dissension within the FOMC about moving to QE2, in part because of questions about the effectiveness of it. So I think they need to have pretty compelling evidence that the economy is slipping, and the economy seems to be muddling along right now, which is not a good news story for the average American, but reduces the urgency, I think, of the Fed doing something.
Could it also reduce the size of what the Fed would have to do?
That's a very difficult question because the Fed itself doesn't know how to size QE2 if it goes that direction, because we're in uncharted territory. We've only had QE1 to go on, and that was when the markets were quite illiquid and dysfunctional, and it had a pretty big impact, and I think it was very positive. So the Fed doesn't have a really good metric by which to gauge the size.
Paul, you said before that if we had a really bad jobs number, we could see the Dow go down. It could be the Dow down another 1,000 points or something along those lines. Now we've got a little bit of a better than expected number. Where does that leave stocks? Does that put the floor on the stocks?
I think stocks are going to be range-bound here until we get new information. I think it would be foolish to have a table-pounding viewpoint short-term on what stocks are going to do, because the market is schizophrenic. You get data on one side and then data on the other side, and the marketplace is suffering from unusual uncertainty, to use Mr. Bernanke's expression.
Right.
So I think it does take out some of the downside. I think if you'd gotten a really wicked report on the downside in the employment today, the stock market would have really stunk up the joint. But I don't think that the data we have right now is a compelling reason to become a table-pounding bull at all.
But doesn't it tell you, though, Paul, that perhaps the equity investors had priced it right with this economy?
Yeah, I think it's important to recognize that the equity market has been on a swoon, so therefore the equity market has been discounting or romancing or increasing the probability of a double dip, and to the extent that today's data reduces the urgency of that probability, then it's logical for the stock market to be doing what it's doing. So I think you're right that we have to recognize that markets price in or discount expectations, and then they change based upon reality versus expectations.
Right, but then you've got on the flip side, Paul, you've got the bond markets. Did they overprice it? Did they overshoot on the downside?
Well, I think the stock market and the bond market have been romancing the same thing, which is a weaker than expected economy. So therefore, when you get data that's better than expected, then logically you should have stocks up and bonds down. Essentially, the stock market is a call option on our economy as a going concern, and the bond market is a call option on our economy as an Armageddon scenario. So therefore, they move inversely.
Right.
So today's activity is totally explicable.
Okay, but where do bonds go from here, though? You think this has been... Does the buying slow down?
I think bonds are going to be range-bound here for a little bit. Bonds had gotten out over their skis when you had your maximum concern about double dip. That could come back at any time. But I think bonds will be range-bound. I don't think we have a big bear market in front of us, for the simple reason that the Fed is going to be pinned near zero for an exceedingly long period of time. And inflation is low and likely to go lower. So the bond market is fair, but within the range of fair, it sometimes will get rich when it gets too pessimistic about the economy.
Right.
I think that may have happened in recent days or weeks.